Welcome to the Susan Brender Show. It's all about you. Featuring shows on health and wellness, the performing arts, politics, and people who inspire you to be your very best. And now, here's Susan Brender.
I'm Susan Brender, and this is the Susan Brender Show. Today we have a very special guest who's going to talk a lot about money and trading stocks and various things that he's doing that most of us are now aware of that it's very important to do. Now, Anmal Singh started trading during his early years without much luck. After a year or so, he discovered a pattern that allowed him to go from zero to over $10,000 per week in profits. I want to welcome to our show Anmal Singh.
Thanks for having me, Susan.
You know, Anmal, you accrued over 7 figures of profits. And this was not only for you, but for your investors. Now, tell us, I mean, everybody wants to know that secret. How did you do that?
Well, I basically collected those profits from trading the stock market. And the way I do that is I navigate the markets. So where a lot of different people who look to, trade into the markets with their maybe Roth IRA accounts or something like that, what they are basically doing is they're buying the market and they're holding it, expecting it to go up. And it's basically, you're buying it and holding if it goes up. Whereas what I do is I navigate the markets in and out pretty frequently. So I try to time the market. So when it looks like it's, quite a bit up there, it's ready to pull back, and I get out of the market. And when it pulls back, when it dips back down, I get back in. So I time the market, so I'm constantly able to beat the market returns.
Yeah, but no. Here's the situation. You sound like a day trader, are you not?
I do different styles of trading. So day trading is something that I do personally for myself, for income generation. But for my investors and for my longer-term accounts is where we look to manage stocks. But we are trading strictly technical. So we don't really care too much about the company. We don't really care about the management of the company or what the company is going to do. We are trading technically based on price action and based on charts. So I would still say I am a shorter-term trader. Mm-hmm. The biggest trade that I've had is something that I might have held on for maybe 2 years. But usually I get in and out of stocks every few days. So I might get in today, and if the stock goes up, let's say 5-10%, I've already beaten the market. So at that point, I get out, and I look to get back in or look to get into some other stock. I move around and navigate the markets.
Now, you talked about two particular words. One was the fundamentals, and the other one was the technicals. Let's define for our audience the fundamentals and the technicals, because there are a lot of people out there who know a great deal about how to do this, but a lot of people really don't understand it. So, what's the definition of technical and fundamental?
Right. So fundamental investors and fundamental traders are making their decision based on the company, the growth that they see on the company, or perhaps the management. So maybe they think Starbucks is going to be opening up in developing countries. It has great growth potential. And they're looking at the management. They're thinking, all right, the CEO is really good. The company has good prospects. And they're really looking at the company's accounting, the books, and making sure everything is great. So those people are fundamental investors. They're making their decision based on the facts of the company and the company's performance. Whereas technical traders, a lot of times we don't even know the name of the company. Oh. What we are trading based on is technicals. So we use charts for all our trades, and we can see a price action history of the stock going back, 10 years. And you will find these areas when you look at charts where the stock seems to always bounce off or get rejected off. Mm-hmm. So perhaps there's a stock, Bank of America. It could not really get above $10 for several years. Several years it was trading under $10. And every time it touched 10, it went back down to 8. Every time it touched 10, it went back down to 8. Every time it touched 10, it went back down to 8. So when it finally got above $10, mm-hmm. that's where I got long, because that told me, all right, it's finally above $10. Whenever there were some sellers at $10, they're no longer there. That's why the stock is now above $10. So that's where we look to buy. And since then, Bank of America, moved from $10 to, $14 or $15, which is 50% return.
Right. Now, should people put stop orders on their stocks because we're living in a time where it's very uncomfortable and very difficult to do or to follow the fundamentals. There's so many issues going on. I mean, take a look at this Praxis information or situation. So, if you have a client, do you tell him to put stop orders, and give us the definition of what a stop order is?
Right. So stop orders, 100% for all technical traders. Using stop orders is a must because that also defines where we're looking to get out if we're wrong. So we're not always right. I mean, I am probably wrong 40% of the time. I win 60% or 70% of my trades, and I lose 40 to 30% of my trade. So the use of stop loss is imperative because that's what differentiates us from fundamental traders. Because fundamental traders might get into a trade and they're holding it in the hopes of the company, but they have really no clue when to get out. What if they're wrong, right? They have no exit point. They don't have their worst case scenario predefined because they're still betting on the company. Whereas our technical traders, we say, all right, Bank of America, we bought it above $10. Let's put an exit point. Let's put our stop loss at $9.50. So in case it goes back down below $10 and goes to $9.50, we were probably wrong about that trade. So let's get out, take a little small loss, and walk away, right? So the stop losses are for traders to protect them and to, get out when you're wrong. And that's the beauty of technical analysis because it gives you the exit points if you're wrong. So every trade we get in, we already know exactly what we're going to lose if we are wrong. And that's the most important thing. Rather than focusing on what you can make, people need to focus on what you can lose. So before I get into any trade, I know exactly what I'm going to lose to the penny if I'm wrong. So that gives me a lot of power because I know my worst case scenario in all the trades. And I try and make 2 or 3 times of what I am risking on that trade.
Yeah. Now, tell me, Anmal, the basis of trading stocks. You talked about the fundamentals and the technicals, but I'd like our audience to know a little bit about or more about the basis of trading stocks. So would you start from the beginning and tell us, say, for instance, I'm a first-time stock trader, and I come into your office and I say, Anmal, I want to, I don't know where else to invest except for in the stock market because it's very difficult now to make any money doing other things, okay? So I want to start. Where do we start? That's what I want our audience to know.
Right. So a lot of people that are, looking to start trading or start basically just controlling their own investments rather than giving it off to a mutual fund or a hedge fund, because, we all know hedge funds and mutual funds, they underperform the market. There's a stat out there, like out of, let's say, 3,000 mutual funds, 2,900 of them will underperform the market. So if you just bought the S&P 500 or if you just bought the Dow Jones and you held it, if you made 8%, the mutual funds are probably going to make less than that. They make like 6%. And then on top of that, they're going to charge you fees. So you basically end up making nothing. So that's why a lot of people come and look to start trading or at least taking control of their investments in their own hands. And the way they start is by a 50-minute consultation. So we have our, if you go to the website, there's a trader challenge out there. So people take that challenge. It guides them in the right direction based on their answers. Then most people come on a 50-minute consultation. So we can, get a feel of what the client is looking to do because trading is not right for everybody. Right. And trading might not be right for a lot of people. So what we do in the call is we try and figure out what people are looking to get out of the market and what are they basically looking to do. So we judge their financial situation and, we're not registered financial advisors, but we give you a brief analysis on where we think you are and whether trading activity is right or wrong for you. So that's the best way to start is to just hop on a call and so we can figure out what the right way is. Now, most people, the way they start is they subscribe to our newsletter or they join our live trading room. So in that trading room, what we do is we actually trade our own accounts live every day. So people can see my screens, they can see my audio in real time while I'm actually trading throughout the day. And that's a great platform for people to come in, watch me trade, and then learn alongside me and my partners. And that's probably the best way to start for everybody. That's how most of our students start. They come in, They, judge the live environment, and that will give them a good idea of whether this is right for them or whether this is wrong for them.
Right.
Right? And so that's how most people start.
Now, trading stocks online versus using a personal broker, which is better? I mean, I know you have a bias to having everybody come to you and you teach them how to trade stocks and make money, but online stock trading now is very popular. Do you agree? And if so, would you recommend that people do such a thing?
Right. As far as your first question about brokers, I mean, use any online broker, right? Mm-hmm. You can use any broker. We are not a broker, so we frankly don't have any affiliation with any broker. So people can choose to trade with any broker of their choice. But I prefer online brokers. And could be any broker, could be E-Trade, they're online, could be Robinhood app that is out there, that's online, could be TD Ameritrade, they're online broker too. So go with any online broker, but do not go with a personal broker who's a person, because a person has a conflict of interest with you. Because the broker does not make money based on what the money he makes you. He makes money on the commission, right? So every time you put on a trade, the broker is going to make a commission. So he almost has a conflict of interest because he wants you to trade. Mm-hmm. And a lot of times there's no trade to be taken in the market. So at that point, we call this thing SOH. We're basically sitting on our hands. So there might be days where I might not trade at all, right?
Right.
And that's important. If there's no good opportunity, you just sit on the sidelines and wait for a great opportunity. Whereas a broker is constantly going to try, get you to trade. Because every time you buy, every time you sell, he's going to get a commission. Whether you win or lose, he's got none of the business, right? Yeah. He just wants you to put on a trade so he can collect his commission. So we suggest online brokers more than any personal person. And as to your second question, yes, online trading is becoming really popular. And the main reason for that is people are really tired of, mutual funds and hedge funds. Because with a hedge fund, you need more than $1 million net worth. Oh. So the average person cannot, go with a hedge fund.
Of course.
And then if you go with a mutual fund, 98% of them underperform even just the bear market, and then they charge you fees. So that's why online trading is really popular, because people want a good return on their investment, and mm-hmm. they're frankly not getting it on Wall Street. That's why most people come into online trading.
Right, right. Now, can a person make a living trading stocks?
100%. I mean, I do make a living trading stocks. My partners make a living stocks, and we have over 200 members in our live trading rooms and our newsletters, and they're all making a living trading stocks. But they didn't start making a living from stocks from day one. Mm-hmm. It takes time. It's like you're picking up a golf club. You're not going to learn just by watching me trade or just by taking a course. You're not just going to magically become a trader. It takes time and effort, right? As I said in my bio, I lost money for the whole first year when I started trading. Mm-hmm. Whole first year. All of the first year, I didn't make a single penny trading, but all this while, I was honing my strategy. I was collecting statistics, right, doing analysis on my trades to get better every single day. And after second year of me trading, I figured out the whole strategy, the statistics. And I'll break it down for the listeners.
Yeah.
Think about it this way. Assume I'm only winning 50% of my trades, okay? Mm-hmm. So I take 10 trades, I lose 5, I win 5. But if my winners are 2 times my losers, statistically, it's impossible for me not to make money, right? Because let's say, as I said earlier, I put a stop loss on each of my trades. So let's say I put a stop loss that if I'm down $1,000, I don't care. Get me out of the trade. Let's take this loss and let's move on. Yeah. So if every trade I'm losing $1,000, for every winning trade I'm making at least $2,000, and even if I'm just winning 50% of the time, statistically, you're going to make money. You lose 1,000, you lose 1,000, you lose 1,000, you win 2,000, you win 2,000, you win 2,000, and now you're up $3,000.
Right. Now, Anmal, take the average person. I'll give you an example. People who are retiring. Okay. So, what should you invest in stocks during your retirement? Because see, the way you are talking and telling us all this information sounds like you have to be, number one, very sophisticated, have a big brain. You have to just really want to take a risk. Now, in the case of retirement, Should you invest in stocks?
100%, but you're going to tweak your approach. So in a younger age, a lot of our traders, they're more aggressive, and they can be, right? So the younger people, they do a more aggressive style of trading, just like what I am doing right now. It's in and out. It's more aggressive style of trading. But if you're in retirement and you're not really looking to, make a lot of money, you're just looking to grow your investment that you have saved up, then you can also trade stocks. I mean, we have tons of people who are retired and trade stocks, but they just use a more conservative approach. So rather than just sitting on their computer getting in and out every single day, they use a different approach. So for them, we don't sign them up for that trading room. Even if they want to, we say, hey, based on what we talked to you, the trading room's not right for you. That's more for active people who are aggressive. However, we have a newsletter that goes out only twice a week. It goes out on Tuesday. It goes out on Saturday, only for members. And in that, we take a look at the markets from a longer-term perspective, and we give them trades that we expect to last 2 or 3 weeks, right? And that is more hands-off approach because you can get the newsletter, you can look at our analysis, you can send us maybe some of the companies or stocks that you're looking at, we analyze them for you, and then we give you your entries, your stop losses, and your target. So for, as an example, Apple is a trade that we sent out on our newsletter just last week, and we got that long that stock around $90, and we said $90, get in long, put your stop losses at $89 if you're wrong, and let's look for $95 as a target. So
it's reached 95 though, Anmal.
Yeah.
Should they invest in more or should they sell off?
I mean, that is, depending on the strategy, but as far as what we did is we navigated the market. So we told people, all right, we're buying Apple at 90, let's put our stop loss at 89. So what are we really risking? We're risking $1 per share, right? And our target is $95. So we're making $5 per share. So that's 5-to-1 reward to risk. And that trade lasted about 4 days. And so those who were following us with the newsletter with their maybe retirement account, they got in at 90, they got out at 95. Now they just sit on the sidelines, wait till the next newsletter, right? So for retirement, that's the approach we use. So they don't trade every day. They buy a stock, they hold it for a few days, they hold it for a week or so, and then they sell it, and they're taking lesser amount of trades, maybe 2 trades a week, as opposed to what I do where I'm getting in and out every day.
Right.
So there's a different approach for different people, retirement accounts and people looking to just grow their account. They're not looking to make a career as a trader, but they're just looking to grow their investment. That's the approach that they will use.
Now, what about dividend stocks? Nowadays, it seems that that's one of the most important stocks to have, are dividend stocks, because you're getting a bang for your buck. Now, do you agree with that?
I think there's definitely a place for that, dividend stocks. I mean, we don't trade based on what the dividend is because the dividend is paid out annually or quarterly on some of the stocks. So if the dividend is, let's say, 1 or 2%, I mean, that's just 1 or 2%, right? That's what you're going to get. Whereas if you're getting in, let's say, Bank of America at 10, getting out at 15, that's 50%. Then we get in Apple at 90, get out at 95, that's another 1 or 2%. So we're looking to navigate and just, collect those percentages. And then we might get into a trade that might hit our stop loss. We might get out. We lost 2%. And we trade that way where we're looking to get a good amount of return on our money because 1 or 2%, is probably not going to move the needle for a lot of people. Even if they have $100,000 saved up, you get 1% on that after a year. I mean, that's not really going to be moving the needle too much. So it's better to trade in and out of the market and not really be concerned about the dividend. That is something you can be if you are totally not into trading. You just want to, collect the dividend. You can do that. But a lot of times what happens is you get paid the dividend, and what happens is the stock price depreciates by the price of the dividend that was paid out to you. So it's basically a zero-sum game.
Now, there is another issue. We're in an election year, and I've been reading and doing a little research about what happens during an election year. Now, I know a little bit about it, but I'd like you to tell our audience what happens during a political and voting time. I mean, we have Trump, we have Clinton. They're very different, and they're going to do very different things with regard to our money. So what would you say people do during an election year? Should they get out of the market? Should they stay in the market? Should they do more investing? What's your opinion of that?
Right. So my opinion would be to first, the listeners should decide what their real goal is. If they're looking to invest for long term and they plan on investing in a stock or a market for more than 3 or 5 years, then you can ignore these little gyrations. Because what happens is these little gyrations are enough for Wall Street to shake the retail average person and scare them out. I mean, really look at it from 2012. Mm-hmm. From 2012 till date, the market, all it's done is go up, right? All it's done is go up. But in between, there were so many things that could scare people to get out. Yeah. We had this Brexit recently, then we're going to have the election. Before that, we had the Greece crisis, then the Turkey crisis, then we had Ebola, mm-hmm. then we had, the greed debt, and then we had the debt ceiling in the U.S. We were, the government's being shut down. We have so many things, and on those events, yes, there's going to be a little reaction. The market's probably going to drop a little bit, but eventually what happens is it ends up coming back up. Mm-hmm. And what happens with a lot of retail traders is they said, I'm going to get out of the markets. They get out, and what happens, it goes right back up, and then they never get in. And when they finally get in, it's too late. So I think if you have a longer-term perspective, just hold on. Don't look at your account every single day, because that's only going to drive you crazy. Just have a longer-term approach. You got into the markets with a 1, 3, 5-year horizon. Let's, take a look at it then. Yeah. Whereas for traders like me, it actually creates a lot of opportunity because we actually thrive on volatility. When we get big moves to the upside, we get big moves to the downside, that creates a lot of opportunity for us technical traders mm-hmm. to take advantage of that volatility. We get to buy stocks really low. We get to sell them really high. Or we get to sell them really high and buy them back low. So that creates a lot of opportunity for technical traders.
Yes. Now, this is a little bit more difficult for our audience to understand, and even me. It's not the easiest thing. I'm talking about calls and puts and shorting stocks.
Right.
Okay, so kind of make it very basic. I want our audience to understand what shorts and calls and puts mean.
Okay, so let's start with shorts. Short is simply the opposite of long. Instead of it as a long, when you're getting long stock, that means you're buying it and you're expecting it to go higher so you can sell it at a higher price to make the profit. Shorting is just the opposite. Selling the stock without buying it, you're selling the stock first, and you're betting for the price to go down. And when the price goes down, you buy it back at a lower price, and you get to collect the difference. So the way this works is every broker can loan out shares to you. So let's say you think, all right, Microsoft is ready to go down, which is not. I mean, I'm just using that as an example.
Yeah, of course.
But let's say you say Microsoft's ready to go down. I think it's at 53. It's probably going to go down to 49. So what you can do is instead of pressing the buy button, if you press the sell button on your broker, mm-hmm. it'll automatically sell those shares. Now what's happening in the background is the broker is basically loaning you the shares. And now you sold those shares at 53. Now let's assume it goes down to 49. What happens? You buy those shares back, which is called a cover. So you buy those shares back, and you basically return it to your broker. So you sold it at 53, you buy it back at 49, and you say, here, Mr. Broker, here are your 1,000 shares that I sold. Here are your shares back. Oh. But what happened? You just made that difference, right? So you sold it at 53, you bought it back at 49, broker gets the shares back that he gave to you, and you get to collect that difference. But on the flip side, let's say you sell it at 53, now the stock goes up. It goes to 54, right? Mm-hmm. Or it goes to 55. Now you got to buy it back higher and give the broker back his shares, and you get to, you lose that difference, right?
Right.
So that's a simple way to explain it. And calls and puts are more getting into options trading. I personally think that anybody who's brand new, mm-hmm. you should ignore calls and puts for now. That is something that you get into later in your career. Mm-hmm. I didn't start trading options until my second year of trading. So for now, I mean, I personally think, if I talk about options, listeners might get confused. So it's best that, readers don't focus on calls and puts. That is something that, you can do later down in, when you get started. Yes. But just first start with buying and selling stocks. That's simple, and keeping it simple is usually the best thing.
Mm-hmm. Now let's turn a little bit more to you and what else you do. You're an avid real estate investor with a large portfolio. Now, real estate has gone up and down for quite some time. in 2008, I mean, we saw, oh my God, we saw everybody selling out because of the situations with the banks. But now, do you still believe in real estate, and is that a place to put your money?
Real estate is definitely something that is a good place to put your money. However, the way I invest in real estate is not to flip it for a high profit. So I'm not a big flipper. I don't like to get the capital gain. I'm not really betting on the appreciation of the property. What I'm looking at is cash flow. So let's assume I find a really great property, okay? Mm-hmm. And mortgage on that is about $1,000 a month, okay? And I have to pay $1,000 a month as a mortgage. Mm-hmm. And what I do is I get that property if the numbers make sense, if it's in a good neighborhood, all that stuff. And let's say now I put it on rent, and I find a tenant who's willing to pay me $1,200 a month. Now look what just happened.
Yeah.
Right? My mortgage is $1,000 a month, and I'm getting a person to pay me $1,200 a month to rent that house. So basically now that person is paying my mortgage, and I get to collect $200 every month. Mm-hmm. Right? And what I do with that is I get another house, right? Now a mortgage on that might be $700 a month. I might rent it out for, let's say, $800 or $900. Now that guy's paying my mortgage. So it's a longer-term game.
Right.
And what happens after 5-10 years is now you got all these houses pretty much paid off, and you've got to collect cash flow along the way.
Yeah, so but don't you have to take into account that things can happen to that house, and if you're not close enough to help change all of the things that need changing or fixing, it's from my standpoint, you gotta have some kind of skill to buy real estate and flipping it as well, because it costs a lot of money to hire people to do that sort of thing.
100%, and that's where property management company comes in. So someone is totally brand new and looking to get into real estate, and he should probably look closer to home so he can get an experience of how to manage the property, how to take care of the tenants or, the typical landlord issues. So the first one should always be close to your home. But what happens is after you get your second, third, or fourth house, you have enough cash flow. Let's assume a minimal amount of $100 or $200 a month from each house. So now you have these 4 houses that are giving you $200 each, okay?
Right.
So you're going to get to collect about $800 a month from these houses. Now what you can do is you can go out to a property management company, and there are some companies out there, they might just charge you $100 a month, $150 a month, mm-hmm. or some even charge as low as $70 to $90 a month to manage the property for you, okay? So mm-hmm. Now if you're giving them $100 a month for each house, and for all 4 of your houses, you're paying them $400 a month to manage those 4 houses. So now you don't have to take care of the typical landlord issues. Mm-hmm. That thing's taken care of. It's all automated. The company's going to take care of all the fixing of the equipment. Anything goes wrong with the plumbing, sink, they fix it. But you're still keeping $400 a month in cash flow, and your mortgage is getting paid off.
Right. And that's really, it's very exciting to think that you can own real estate and you can invest in stocks, which make people feel that there is something, there's hope for making a little bit of money, because a lot of people all over the world are finding it very difficult to find jobs. So if they have just a little money just aside, would you recommend, no job, okay, so keep that in mind, no job, but they have, say, $10,000 put away that maybe their parents gave them or what. So would you suggest that they invest in stocks or real estate? Which is the best thing to do when you're just... Yeah, go ahead.
Yeah, I personally think that if you do not have a job and $10,000 is all you have, and that is something that you need to live off, then probably it's not right for you. You should first focus on maybe saving up a little bit more, or taking a portion of that, not taking all of what you have saved. Let's say you have $10,000 saved. You take $5,000 and you start trading in the market, right? That's where I started. Because I started with $10,000 initially, and what I did was I was just trading stocks, because at that time I didn't have any money for real estate. Mm-hmm. So I just did stocks, and that's how I made my money. And then using that money that I made from stocks is when I went into real estate. So what people need to do is, I personally think, get a job, even if it's not a proper job, but get any sort of shift. Mm-hmm. So a lot of the traders that I know, one who's almost on track to make six figures already this year, a coaching student that I worked with.
Fabulous.
So he didn't make any money for the first 6 months, but he needed to still survive. So what I told him was, hey, get another job, get something, so now you can trade in the mornings with me, all right? And now you also have, let's say, a night shift somewhere, making minimal amount of money, but that's enough money for you to at least survive while you learn this craft. So that's where I think most people should start. So save up more money is number one option. Number two option is to get maybe another job. I know this trader who is making $100,000 a year, but he still drives Uber at night.
There you go.
So he's making $50,000-$60,000 driving Uber every year, and he's also trading and making $100,000. So what that does to a person's mindset is that he can trade without being scared because he knows that his bills are going to be paid off. And now he could just focus on trading the right setups, trading the right pattern. If there's no trade to be taken, you just sit back, you relax. You don't need to push the button.
Right.
So it all depends on a person's effort, what they want to do. As I gave you examples, one guy's working at a job, the other guy's still driving Uber, and he's still making $100,000 trading, but that gives him the comfort that, all right, my family's going to be taken care of. So that's what's really important. But if you have no job, you only have $10,000, I would personally suggest keep $5,000 and maybe take $5,000 and start learning and start investing. And once you actually get it, then you can put your money. So another thing we do is when our trader takes our program, we put him on a simulator demo account for about a month. Okay? So they're actually trading the real markets, but it's not real money. They can make all the mistakes. They can make all the errors in an environment where it's actually just paper money. So you don't lose anything, but you still get to learn. And when you finally start making money on a demo account consistently, boom, that's when you take your money, real money, and that's when you open a real account.
What an interesting way to learn how to be a person who is a buyer of stocks. That's a great way to learn. It sounds like you're getting almost your PhD in stocks. That's wonderful. I think that's great advice. Now, there was a time about 20 years ago, and people who wanted to buy stocks were advised to go take a look at a business. Like, for example, let's talk about, you mentioned Starbucks. At that time, people would go into Starbucks and they would watch the patterns. They'd watch people coming and going, what they were buying, how successful it was because lots of people were coming inside. And that's when people advised them to trade. They said, okay, now you're understanding more about the company, whether it's making money, whether it's not, and if it's not, stay away from it, but if it is, this is a great trade. Now, does that philosophy stand today?
I think that was definitely a great philosophy back in the 90s, but now it's almost impossible to do that because you might, let's say, live in New York, and you might go to a Starbucks and you see, wow, it's really busy all the time, and then you might go to a Starbucks in China and it's totally empty and they're losing money there, right?
Right.
So it's really hard to do that with globalization because every company has different shops in different countries, and it's really impossible to go at each shop and take a look at what's really happening. And you got to look at the trends. And the same thing, you go to a 7-Eleven or you go to a Starbucks or you go to anything in Manhattan, and your view is going to be, wow, this business is booming. It's going to make a lot of money. And then you go to the same shop in a suburb and it's empty.
Yeah.
So, and they're losing money there. So that thing was great. I definitely agreed with that back in the day, but I think now it's irrelevant. I think fundamentals overall are really irrelevant these days because of the information flow. Information travels so fast that there's no real edge. If you are reading an article about a company and looking at, oh, wow, this analyst thinks it's got great prospects, this company is doing great, but think about it. That article's on the internet. Everybody's read it. Everybody who wanted to buy has already bought it. So who's going to buy it now? Because you need someone more to buy for the stock to go up.
Right.
So the information is already out there. The information travels really fast these days through social media, and anything comes out on a company, it's all on Twitter within the next second. So there's no real edge. And the reason why fundamentals worked, in 1990s is because the information flow wasn't that fast. So you could go out and see a shop that is really, really empty, but nobody in social media will know about it. So you can make a decision that the company is probably declining, and you can go and sell their stock.
Fantastic.
Nowadays, information travels really fast. There's no real, you don't have an advantage over anybody else.
Right. Now, we have so much more to talk about, but it's almost our time, so I'm going to invite you back. But here's the thing I want to know, Anmal. Can you, I mean, I think our audience would love to know what you're thinking is the future of stocks. And is there one thing you want to tell them that can help them to become successful when they trade? What do you think is going to happen in the near future?
Right. So in the near future, market has recently been really, really strong, and it looks like it wants to continue the trend. However, someone who is looking to just, get into the markets, not trade, but just invest, buy the Dow Jones or buy the S&P, I would personally wait. I would not buy the market here. It's looking strong. However, it's quite a bit up there. It's a little bit extended that I think it might pull back a little bit in the next few months. So my personal opinion, if you're looking to invest into markets, stay on the sidelines for now. Don't commit your capital into the stock market unless you are trading, because that's different, because you're getting in and out, so you don't really care about what happens next day, what happens next week. But as an investor, I would stay out of the markets.
Now, if you were... but if you already have most of your money in the market, would you sell?
Again, that would bring me back to a person's, goal. Did you commit to the markets for a 3 to 5 year horizon? If so, then, you can ignore these little gyrations. But if you are still holding the market and you have gain, it's not a bad idea to take at least some of the gains. So what we tell our traders is, let's say you have 100 shares of the S&P 500, okay? Mm-hmm. And that is going up, and you're up your capital, still half of your position, right?
Right.
Still half of your position, taking a little profit, so now you can feel comfortable, and then you can just let the other half go and see what happens. So that's what people have to do. They have to at least take a little bit profit when the market gives them. Because look what happened since 2014 or 2015.
Right.
The market basically did not do anything until just last week.
Right.
But it gave you, in those gyrations, it gave you so many opportunities. Market was up 10% at one point, it was up 5% at one point. But if you just held it throughout those moves, you basically break even, right? Mm-hmm. But if every time you were up 5-10%, you sold a little bit, and when it dropped back down, you can buy it back, you will be able to really outperform the market and generate good returns for your portfolio. Now, for those looking to, get started or learn more about, I guess, my approach or what we do, mm-hmm. Our website's up there. It's livetraders.com, and that will give people a lot of information. And I'm happy to schedule a phone call mm-hmm. With one of my traders so people can talk to them for 15 minutes and really decide what kind of activity, or even if this activity is right for you. That's where I think people should start. And we also have a free ebook that people can download. And, great blog posts on there. We have some great YouTube videos that people can watch to learn more about our approach and to really figure out if this is something that they want to get into or not.
Mm-hmm. Anmal, repeat for our audience how they get in touch with you or some of the people who work for you.
Sure. The best way would be to head over to the website, which is www.livetraders.com. And you can go there, and on that page, you'll be able to take a trader challenge, which will guide you to which program is right for you. And also, you can schedule a 15-minute consultation with our trader, and who can, walk you through the process and how everything works, and to really decide where you are at with your future. So you can do that by just going to the website, livetraders.com. There's a phone number there that you can dial, or you can email us at info@livetraders.com. Our social media channels are also listed on our website, and I think we post a lot of great insight and motivational posts as well on our page that people can benefit from.
That's fantastic. There's only one other thing I want to ask you, and that is that you're working with students with your Live Trader organization. Are these young people, or when you call them students, are they any age?
Oh, no. We call them students just because they're learning phase, but we have traders all the way from 18 years old till 65 years old, right? And most of them are even older than me. but they're still students. Anybody who's new to the market in the learning process, we call them students just to keep them humbled, because a lot of people also come from a background where they've already made a lot of money. Maybe they sold a business, maybe they were a successful lawyer in the past, now they're retired, just looking to trade, make a little bit extra income on the side. And what happens then is those people they're really egoistic because they had really good success in their past businesses. And then they come in and they think, oh, market, I can do anything with the market. Markets can be more intelligent than me. So they have this little ego.
Right.
We, say, hey, you're new to the market. Market is stronger than any of us. You're still a student. Learn. Focus on learning because the market is bigger than you, me, or anybody.
That's great advice. Well, today my guest has been Anmal Singh, and he is a very, very interesting person because he's got a lot of information and education to offer you if you're interested in the whole stock market and investing and things of that nature. So I will thank Anmal for being on the Susan Brender Show. It's really a pleasure.
Sure. Thanks for having me.
Thank you for listening to the Susan Brender Show. To be a guest, email sebrender@yahoo.com.